Hello everyone, welcome again. We will continue with the capital gains tax. Now we will look at some of the reliefs which are available as part of the capital gains tax. One of the reliefs we have already seen earlier in the video, in one of the previous videos, which was entrepreneurs relief. The rate of capital gains tax, is different, whereas a capital gains tax rate for entrepreneur relief, the assets which qualify for entrepreneur relief, the tax rate is 10%. That's why it is called a relief, because we are paying capital gains tax at the reduced rate of 10%. Right? Now that was one of the reliefs which are available in capital gains tax. Now we will see a couple of other reliefs as well, which are part of the capital gains tax. Now the reliefs which we are going to study now these are the deferral reliefs. Unlike entrepreneur relief, in entrepreneur relief you pay tax at the reduced rate of 10%, whereas these reliefs which we are going to study now, these are deferral reliefs. Now what does the deferral means? Deferral simply means that you don't have to pay tax now, but you are deferring it for the future period, which means that you will have to pay tax in the future time. Right? So these are deferral reliefs, that you are just postponing the tax liability. You will have to pay eventually in the future, but you are not paying now. Now you might think it's not good because you eventually have to pay anyway, so it is not good. But basically from business point of view, it is good, because sometimes you have to do rather important things than paying this tax liability. So you concentrate on them important things, and then you will think about the tax liability in the future. So from business point of view, it is better. Now I will just share the screen with you so that you can see on your screen. So as you can see on your screen, this is page number 39 of your lecture notes, and rollover relief. First one of which is a rollover relief. Now what happens that whenever you buy an asset, you have kept this asset for a while, and after that you have sold this asset. When you have sold this asset, then definitely you have got some money out of it. Now if you have reinvested the whole money into buying another asset, if you have invested the whole money and bought another asset, then whole of the gain which you have made in the old asset will be deferred. You don't have to pay any tax liability, any capital gains tax on that. That is called a rolled over relief, because you have rolled it for the future period. So that is called a rollover relief. So I will repeat the scenario again. I've bought a computer, or I would say I bought the iPad. So I've bought the iPad, and after 1 month I've sold this iPad, and then I bought another iPad which is the latest version. Right? Now I've sold this iPad for £300, and the new iPad which I bought, I've sold this iPad for £300, and the new iPad which I bought was £330, which means not only I have contributed all of these proceeds into the new asset, but I have put extra £30 as well. So all of the gain which I have made on this old iPad, if I have made any gain, all of that gain will be deferred for the future period. So I won't have to pay any capital gains tax now. I will have to pay capital gains tax in the future. Now say for example, if I bought this, if I have sold this iPad for £300, but I have not reinvested the whole amount in the new iPad, I've just reinvested the £250. So I sold this for £300 and I bought the new one for £250, which means I'm not reinvesting the whole amount. I am reinvesting part of the amount. I'm reinvesting £250, and I am not reinvesting £50. Now the amount which I'm not reinvesting, in this case £50, amount which is not reinvested in the new asset, will be immediately chargeable for capital gains tax purposes. Rest of the amount, gain on the rest of the amount, will be deferred for the future periods. Right? So that is the way to calculate it. So if you have reinvested the whole amount, then whole amount will be deferred. If you have not reinvested, the amount not reinvested will be chargeable immediately, and rest of the amount will be deferred. Now as you can see on your screen, a rollover relief. So you will take the sales proceeds of the asset which you have sold, and will deduct the cost out of that, and then will deduct the indexation allowance as well if it is a company. As you know that for companies we will get the indexation allowance, we won't get annual exempt amount for the individuals, indexation allowance for companies. Now after that, amount which we have not reinvested, in my example £50, that will be chargeable gain, and we will have to pay capital gains tax immediately on that amount not reinvested. And the remaining amount is going to be gain rolled over, and that will be the gain which we have to pay tax in the future period when we sell the new asset. Right? Now say for example, if we have reinvested in the new asset, and the new asset is going to be land and building, non-depreciating asset. Now there are two kinds of asset, which is one is depreciating asset and the other one is a non-depreciating. So non-depreciating means land and building, because we know that land and building cannot be depreciated. It can be appreciated, because by the time in the future the value of the land and building will be increased, it will not be decreased. So that's why these are called non-depreciating assets. Now if you have reinvested in the non-depreciating asset, we'll take the sales proceeds of the new asset when we sell it, then we will deduct the cost of that. Now we'll take the actual cost, and then we will reduce the actual cost by the rollover gain which we have rolled over earlier. Right? Now it says ABC. Now what is ABC? If you look above that, this ABC is the gain rolled over. Now gain rolled over is also ABC, and this gain rolled over will be deducted out of the new cost. So it will reduce the cost. So when it will reduce the cost, it means it will increase the gain. So we will have to pay more tax on that. Now the gain which we have rolled over earlier, we are paying tax on it now, in shape of reducing the cost, and in shape of when it reduces the cost, it will eventually increase again. Now I will just show you an example on that, which I have made at the end of this chapter. As you can see on your screen, rollover relief. Williams Limited acquired a factory in April 2000, right? And the RPI at that time, retail price index, was 170.1 at a cost of £120,000. It used the factory in its trade throughout the period of ownership. In August 2015, when the RPI was 258.4, D Limited sold the factory for £220,000. It says D Limited, it's not D Limited, it's the same company, Williams Limited. In November 2015, it acquired another factory at a cost of £190,000. So calculate the gain. It says faint, it's not faint, it's gain. Calculate the gain chargeable on sale of the factory and the base cost of the second factory. So first factory was bought for £120,000, and it was sold for £220,000. So take the sales proceed, which is £220,000, as you can see on your screen. Now we'll deduct the cost out of it, which is £120,000. We deduct the cost. After that, we'll have to deduct the indexation allowance. Now we know how to calculate the indexation allowance. RPI in the month of sales less RPI in the month of purchase over RPI in the month of purchase, multiplied by the gain. So that will be the indexation allowance which we deduct. Now after that, it is indexed gain, and as you can see on your screen, 37,720 is the indexed gain. Right? Now the amount which we have not reinvested in the new factory, because in the new factory he has only invested £190,000, so he has not reinvested £30,000. So the £30,000 which is not reinvested, that will be immediately chargeable, and the rest of the amount, whatever the balancing figure is, that is our rollover relief. Right? Now just beneath that, if we calculate the base cost of the new factory, so cost of the second factory was £190,000, which will be reduced by the rollover relief, which will be reduced by the rollover gain, 7720, and the new cost for the second factory is going to be 182,280. Now the rollover relief which we have rolled over for the future, we did not pay tax earlier, so we are paying tax now here by reducing the cost of the new factory. When the cost of the new factory is reduced, it will increase the gain. When it will increase the gain, we'll pay more tax. Right? So let's go back to where we were before. Now rollover relief, if we have reinvested in depreciating asset like plant and machinery. In the previous scenario was we are investing in the non-depreciating asset, where this time it is non-depreciating asset. Now this case, the gain will be freezed, so you don't have to pay a gain. You don't have to pay gain on the rollover relief until the earliest of these events. So whichever the event happens earlier, on that date, the gain will be chargeable. Now, what are these cases? What are these dates? Sale of the new asset, freezed until the earliest of. Sale of the new asset, 10 years, and new asset cease to be the business assets. So most likely cases, the earliest one in this case is going to be 10 years because sale of new asset is up to us. So whenever we want to sell, if we want to sell it for after 20 years, it's up to us. And the new asset cease to be business asset, it is also up to us. Whatever amount of period we want it to use for business purposes, we can. So the earliest event which can happen in most cases is 10 years, but it can be any of these. So whichever event happens earlier of these, so say for example earliest one was we have sold the asset, that on that date this gain will be taxable, right? And there's a little different way to calculate the gain. So we'll take the sales less cost, and then we'll deduct the indexation allowance out of that, and then the amount not reinvested will be chargeable immediately. The gain which we have held over, that is the gain which we have to pay tax on. Now how do we pay the tax on that? Let's see it a little different way. So we'll take the sales of the new asset, then we'll deduct the cost of that, and after that indexation allowance. Now whatever the chargeable gain is, we'll have to add the gain into this one. So we'll have to add the gain instead of the reducing the cost in the previous, unlike in the previous case. This time we'll add into the gains. Let's do an example on this one as well, so you will understand this topic better too. Now in this case it says Alam bought a freehold shop for use in his business in June 2015 for £125,000. Mr. Alam. So he sold it for £140,000 on 1st of August 2016. So he sold it for £140,000, whereas he bought for £125,000. So the gain is going to be £15,000, as you can see on your screen. This gain is deferred in relation to the purchase of the plant and machinery, as all of the proceeds have been reinvested, because he has bought the new machinery for £150,000, which means all of the proceeds are reinvested. So this gain is going to be chargeable on the earliest of the three events which we have seen. Which are earliest of the three events? Which are the three events? First is the 10 years, then the second one was sale of the asset, third one was the we cease to use it as a business asset. So let's see if any of these three events happening in this question. He then sells the plant and machinery. So he's selling the plant and machinery, which means that this is the event when the chargeable gain will become taxable. He sold for £167,000. So we'll take the sales proceeds of £167,000. We deduct the cost out of it, which is £150,000. So the gain is £17,000. Now this gain plus the gain which we have deferred earlier, which was £15,000. So 17,000 plus 15,000, the total gain is £32,000, on which we have to pay tax this time. Right? So let's go back again. After that, on page number 40, it tells us the conditions for the rollover relief. And please mark it as important, because these are very, very important for capital gains tax purposes. Right? So conditions for rollover relief. A gain may be rolled over or deferred where proceeds on disposal of business assets are spent on replacing asset. In order to roll over, the following conditions must be met. Now what are these conditions? The old asset and the new asset bought both must be used in the trade by person or company claiming the rollover relief. So it must be used in the business. The old asset sold and the new asset bought both are either land and building or fixed plant and machinery. And the third one, it says reinvestment of the proceeds on the disposal of the old asset takes place in the period beginning 1 year before and 3 years after the disposal. So there are 4 year span period basically. So 1 year before and 3 years after the disposal. And the last condition is that new asset is brought into use on its acquisition. So you must brought into use, you must bring it into the use of the business on its acquisition. Right, after that, held over relief. Say for example, if we have bought an asset and we have done some insurance on it as well. Now in the UK, as you know, most of the assets are insured. So say for example, if I bought this iPad and I have insured it as well. Say for example, if anything happened to this iPad and it's broken, or it's, you know, my house caught the fire, and it, you know, this asset was also in it, which was insured, and insurance company paid me whatever the amount insurance company paid me, that will be the amount which will be called as, which will be assumed as sales proceeds, because I haven't sold it. However, insurance company has paid me whatever the claim was. So that amount will be considered as insurance proceeds, and we will work our way like that. So we'll take the sales, which will be insurance plus scrap, and deduct the cost out of it and indexation allowance. Amount not reinvested will be immediately chargeable. Rest of the amount is going to be held over. Now in the replacement asset, we'll take the sales, and like we did earlier, we'll take the cost, and which will be reduced by the held over relief, and we'll deduct the indexation allowance out of it as well. That will be the amount on which we will have to pay chargeable, on which we have to pay capital gains tax. Right, let's do a question on this one as well. Give me 1 second if I have one. I think I got one question on this one. Yep, on page number 43. Excuse me. Right, page number 43. Ravi bought an asset for £25,000. It was destroyed in July 2015. Insurance proceeds were £34,000. So the insurance proceeds will be our sales proceeds. So proceeds are £34,000, as we have as you can see on the screen. Cost is £25,000. But however, Ravi spent only £30,500. So the amount not reinvested is immediately chargeable. The rest of the amount, will be freezed, will be held over until the new asset is sold. And in the new asset's cost, this rollover relief, this held over relief will reduce the new asset's cost. All right. So as you can see, just beneath that, the base cost of the new asset is going to be 30,500 less 5,500, and which is £25,000. Right, now in page number 41 we have to do the last relief, which is a gift relief. Now whenever I am making a gift, or you are making a gift, obviously when you make the gift, you don't have to charge any money, do you? So because you are making a gift, sometimes you make a gift because you are making a gift to a close family member or a friend. So when you make a gift, normally you don't charge anything. You can make a gift, but you charge less than what's the market value. That is also called a gift. Say for example, if I have a car, which value of the car is £2,000, but I am only giving for £500. So I'm giving a gift of £1,500, right? Because I can sell it in the market for £2,000. However, I'm just giving for £500 to my friend. So that is also a gift. Now for gift purposes, we will take the market value whenever we are taking the sales. So sales will be market value for capital gains tax purposes. We won't take the actual sales price because it is a gift. So for gift purposes, in the capital gains tax, we'll take the market value. Right? Now as you can see on your screen, for the transfer, we'll take the sales, which will be the market value, and then we'll deduct the cost out of it, and after that it says amount received in excess of cost. Now whatever your cost was, if you have received anything in excess of that, that is going to be immediately chargeable, and the rest of the amount is going to be held over. Right? So for transferee, we'll take the sales, then we'll deduct the cost out of it, and cost will be the market value obviously, and then this cost will be reduced by the earlier gain, and earlier relief, and the rest of the amount is going to be chargeable gain. On page number 42, we have a question about the gift relief. Give me 1 second. On 6th of May 2016, Angelo sold to his son Dilshan a freehold shop valued at £200,000 for £50,000. right? Now the market value was £200,000, whereas he sold it for £50,000. For gift relief purposes, we take the sales as market price. So we'll take the sales as £200,000, whereas the actual sales was £50,000, because it is a gift, right? So we'll take the sales proceeds as £200,000. Now let's see how much was the cost. And claim the gift relief. It says Angelo had originally purchased the shop from which he had run his business for £30,000. Right? Now he has bought the shop for £30,000. We will deduct the cost out of it. Right? Now let's see that how much extra he has got in over his cost. His cost was £30,000, whereas from his son, I think, from his son he's taking £20,000 extra on top of his cost. His cost was £30,000. He is selling for £50,000 to his son. So he's taking £20,000 extra. Now this £20,000 is going to be immediately chargeable, which is in excess of the cost. So £20,000 is going to be immediately chargeable. The rest of the amount is going to be held over, gift relief. And whenever the Dilshan is selling, and in the question as well, it says Dilshan continued to run the business from the shop premises, but decided to sell the shop in March 2017 for £195,000. So we'll take the sales, which is £195,000 for Dilshan. Let me just scroll it down. So £195,000 for Dilshan is the sales. Then we'll take the cost out of it, market value, which was £200,000, and we will deduct the gift relief, which is £150,000 out of it. So it is reducing the cost. So eventually it is increasing the gain. Now we are paying the tax on the gain which we haven't paid earlier, so we have to pay now. So the eventual gain is going to be £145,000. Right? So we have done our capital gains tax. We'll see chapter number 17 in our next video. And so we will see our chapter number 17 in our next video, which is also, basically, which is part of the capital gains tax, I would say, because it consists on, theoretical aspect of ACCF 6, not only capital gains tax but also income tax. Right? So I will see you in the next video, and we will see the chapter number 17. Thank you very much, and goodbye.